Hi, welcome to the market alert for Tuesday, the 1st of March 2016. Starting off in yesterday's pre-market session, you can see the market there being moved higher by 150 points before we get to the official session, and then we get the first signal to the downside there. See the market just trading down to the 16,600 level there before finding support and reversing and moving to the upside. No signal here because the market didn't trade below and then close back, which is a shame. And just here as well, we missed out because the market didn't close back above the psychological level there. Otherwise, we'd have had another buy up to this point here. We then go into the quiet period, having already taken 20 points off the table. We then get another buy, which results in the market reversing and moving back to the downside there. And this is a 22-point loss on this trade as the market reverses, giving up the profits from the first trade there. And then we see the market trading down to the psychological line of 16,650. The market at this point found support, but eventually broke, but it was a bit too late, already out of the market. But I can show you a way how to if you want to give the market a chance to breathe. And the only reason I came out of this is because I've been barking on for weeks about them ramping the market in the evening session. It looks like they've stopped doing this yesterday. No sign of the plunge protection team, and these sorts of observations are what you've got to take note of given the current trading climate. So now it looks like they're actually not bothering. There may be another reason for this as well, which I'm going to come to before we conclude today's market alert as well. Some very interesting news that's come to light. But the way you could have handled this, if you wanted to test the market to see if it was going to go any lower, and like I say, only because the plunge protection team have been ramping the market every day for the last 2 or 3 weeks, and now it seems like they're not going to bother. So there's two ways to do this. You can move the stop to break even to the entry price and see if it breaks, which it did, and then trail the stop down. Or you can actually, when we get down to the level here where we've got these lower highs, we get down to the 16,650, you could move in at 50% there as well, or 100%, or just the break even, as I say, the first option, and then see if the market moves low if you want to, you know, happy about giving up a few points. But like I say, my reason and rationale for coming out was quite simple. We've had weeks of the market being ramped from 3 p.m. New York time. Just go back and have a look at the charts, and this is the first time we haven't seen any sort of assistance in supporting the market, which is a very interesting change in what we've seen of late. So we've got the market down for the last 2 days, trying its best to come back, and what I would be inclined to do now is this. I'm going to mark up a 76% retracement on this market. If the market fails to close above 16,750 or 16,709, then a longer term trade you can tuck underneath the rising lows should we get them, as the market moves back up to this these two areas here of natural resistance. So I'm going to save that. We'll keep those in the actual chart. On the news front, we've got ISM manufacturing. That's all that's out at 3 p.m. today. There's no Fed rhetoric to be delivered to the market today. This is the manufacturing is forecast to be just slightly higher, but I don't know whether that will be the case or not, because yesterday, even though I predicted an increase in pending home sales, we saw a massive drop, one of the biggest drops in pending home sales for the US. And that again is another indication of the slowdown. All of the economic data is just incredibly poor, and yet this market remains on the highs. But I don't believe that's for much longer as we go into March. I think we're going to see a massive move to the downside. I don't know why. But there's just something about this squeeze that we've seen, this dead cat bounce, that it's looking tired, run out of steam. The implied volatility also goes on to confirm that. And yesterday, you can see there 1778, up slightly on the previous day, but we've had a big enough pullback on this. What we could do with is the blue line below the implied one, though, just before this actually moves higher. So we could do with the underlying market also moving higher and going and testing those 62 and 76% retracement levels as well. And the other reason the market was down yesterday, I don't know whether this is a conspiracy or not, but it's interesting that the New York Stock Exchange, as of yesterday, Monday, last week, a bit late with this news actually, February the 26th, the New York Stock Exchange have removed stop orders. Now, the nonsense that they cite in here is because there's been intraday volatility swings, and it's not good for the holder of stocks, to see the position taken out and then the market move back in their favour. There has never been a time in history that a stock exchange has had any interest in an individual trader and their positions. So first of all, that's the red herring. Nobody cares in the financial industry about your position. The only person that could care about your position is yourself. So that is a red herring completely. It's the reason they've moved it is very, very simple, and that is that stop orders could be placed. Let me show you an example to indicate this. Let's say the market's come down, it's tested this area here, and what will happen is a lot of traders will then move and place stops just below this sort of area. And if there's weakness in the background like we've got in the stock market, any sort of support area becomes a potential area for sell stop orders to be placed. And the great thing about a sell stop order was, for those that trade via the US brokers into the US market, this doesn't affect spread betting, by the way, at the moment. Stop orders are still valid. Is that you end up with thousands and thousands of orders at these levels, because everybody knows that if the market breaks this, then we're going down to the next level, which is why we draw these lines in. So what they've done in a move is to actually remove stop orders totally, buy and sell stop orders, and also good till cancelled orders as well. So you can't actually place these orders, leave them, and then come back and see what happens. So you've actually got to be at the coalface to see if the market is trading at those areas now in order to activate those trades, which is the reason they've done it is quite simple, because if they get too many people selling, the momentum will then increase to the downside. And this is one way of deterring that, because you're going to have to find some other way of actually getting that order onto the floor. No doubt there's some very nimble programmers out there at the moment who are actually writing algorithms to actually do this and then still send the order as if it looked like a market order. But a very interesting situation at the moment that we're seeing with regards to this. Right, that's it for today. I will see you in tomorrow's. Have a great day. Thanks for your support and also for watching. See you in the next one.